10 times this year, an entire stock market shut down. And every single time, it dragged Nvidia down with it. I'm Alex Carter. Welcome back to Wealth Signal. Quick note before we dive in. This video is for educational purposes only. It's not financial advice. Always do your own research. Here's what most investors got wrong this summer. When Nvidia dropped hard at the end of July, everyone assumed it was about AI fears, or a bad earnings whisper, or some crack in the fundamentals. It wasn't. What actually happened had almost nothing to do with Nvidia itself, and everything to do with two countries most American investors never even watch: South Korea and Japan. Missing this connection means you'll misread every single one of these dips as a reason to panic, when it's actually the exact opposite. These forced, liquidity-driven sell-offs, where healthy companies get dumped for reasons that have nothing to do with their business, are some of the best discount windows the market hands you all year. And based on what's been happening in Korea and Japan, this setup is not done playing out. I've spent real time pulling the actual halt data out of Korea and cross-checking it against every one of these drops in the US market. And the pattern is honestly striking once you see it laid out. If this kind of connect-the-dots analysis is useful to you, do me a favor and hit subscribe now. It genuinely helps this channel keep going, and you won't want to miss the next time this setup fires. So today, I'm walking you through 4 stocks tied directly to this Korea-Japan volatility loop. One of them is the most obvious name in the market. The other 3 are ones almost nobody connects to this story. But by the end of this video, you'll understand exactly why they should be on your radar, and which one of the 4 I think deserves the top spot on your watch list. Let's set the stage properly, because this only makes sense once you understand the 2 separate fires burning at the same time. First, South Korea. Their stock market is dominated by retail traders running heavy margin and leverage. Think of it like a Jenga tower where almost every piece is loaded. The smallest hiccup in a name like Samsung or SK Hynix, and the whole tower doesn't just wobble, it collapses fast enough that the entire market has to halt trading. Not one stock, the whole market. And the numbers back this up in a way that's hard to ignore. South Korea's market has halted 10 separate times in 2026 alone, with 4 of those 10 happening in July by itself, basically once a week that month. Even the head of the South Korean Stock Exchange came out and publicly apologized to the country for letting this level of leveraged ETF activity build up in the first place. Second fire, Japan. For a long time, the US dollar has been strong against the Japanese yen, and that's created something hedge funds call the yen carry trade, essentially borrowing cheap Japanese money to buy American stocks. The problem is, when interest rates shift sharply in either country, that currency gap changes fast, and fund managers are forced to unwind those trades almost overnight. That unwind doesn't just hit Japanese stocks, it drags American equities down with it, because a wall of money has to exit the market all at once. Put both fires together with AI bubble anxiety already sitting in the background, and you get exactly what happened to Nvidia at the end of July. Analysts are calling it the triple whammy. Earnings jitters, a Korean market halt, and a yen bailout news cycle, all landing back to back to back. Nothing about Nvidia's actual business changed. It was a pure liquidity event. Wait, Nvidia dropped for reasons that had nothing to do with Nvidia? That sounds backwards. But that's exactly the setup that made it one of the best buy-the-dip opportunities of the summer. Here's the mechanism. Nvidia's high-bandwidth memory supply runs directly through SK Hynix. So when the Korean market seizes up, it creates real supply chain anxiety around Nvidia, even if nothing about the actual chips has changed. On the Japan side, when the yen and the Nikkei get shaky, algorithmic trading kicks in automatically, and those algos sell off American equities to raise cash fast. And when hedge funds need liquidity in a hurry, the first place they go is the most liquid, most owned name in the market, which right now is Nvidia. It's the gold standard, so it's the first thing that gets sold when someone, somewhere, needs cash immediately. Look at the chart around the end of July. That's the triple whammy window we just talked about, and Nvidia took the sharpest hit of the entire market during it. That's not a coincidence. Nvidia leads market reaction across the board. When you see a violent move in Nvidia, you're usually watching the leading edge of a broader wave, not an isolated event. Now, here's the part that matters for your strategy. This is not a one-time event. The head of the South Korean exchange has openly admitted the leverage problem hasn't been resolved, and the yen-dollar relationship is still described as unstable by Japan's own administration. Which means the next time you see Nvidia drop hard alongside a KOSPI halt or yen headline, with no actual bad news out of Nvidia itself, that's your setup. Imagine being the investor who understood this pattern back in July and used that dip to add to a position, instead of watching from the sidelines wondering what went wrong. That's the difference this kind of analysis makes. Memory chips in 2026 basically come down to three companies fighting for the same territory: Samsung, SK Hynix, and Micron. That's it. That's the whole club. And that concentration is exactly why Micron becomes so important the moment Korea starts shaking. When the Korean market freezes and Samsung and SK Hynix effectively go dark, hedge funds still need memory sector exposure to hedge their positions, so they turn to the one memory stock they can still trade freely: Micron. It becomes what's called a liquidity proxy, getting sold off on the assumption it'll move the same way its Korean rivals would have, even though nothing at Micron itself has changed. Now, your first instinct might be, if Korea's shaking, why not just buy SK Hynix directly on the dip? Here's the but turn. SK Hynix is literally the piece holding up that leveraged Jenga tower we talked about. It's the most owned, most leveraged name in the South Korean retail market, which means when the tower falls, SK Hynix falls first, and it falls hardest. Until that Korean market genuinely bottoms out and deleverages, you don't actually know how much more room it has to drop. Micron, on the other hand, sits in a much safer spot for one concrete reason. Its production capacity is already contractually sold out all the way through 2027. So when Micron gets dragged down purely because Korea halted trading, you're not buying a company with uncertain demand. You're buying a company with locked-in revenue at a discount it never should have had in the first place. Looking back at the chart, Micron is only just now stabilizing from the last wave of these events in July, which tells you the pattern hasn't fully played out yet. The takeaway here isn't chase the obvious Korean name. It's find the American proxy that gets punished for someone else's crisis, while its own fundamentals stay untouched. Quick question for you. Drop a comment below and tell me, out of Nvidia and Micron so far, which one would you actually add to on the next dip? I read every comment, and I want to know where your head's at. Before we move on, everything I've referenced visually in this video is saved as a downloadable summary file in our Wealth Signal Telegram channel, along with every past and future videos file. Links in the description. Go grab it. Every chip that leaves a factory has to pass through one final gate before it ships: testing. Skip that step, and you risk shipping a $30,000 to $100,000 piece of hardware that turns out to be a completely useless paperweight. There's exactly one company that dominates that gate: Advantest, and I like to think of them as the ASML of chip testing. Just like ASML has a total lock-in on the lithography machines that print chips, Advantest has that same kind of lock-in on the benches that test them once they're made. No company can ship a finished chip out the door without going through equipment like theirs first. And because they're based in Japan, anytime the yen takes a hit against the dollar, Advantest's stock suffers far more than a company with this kind of moat ever should. Japan's own administration has acknowledged they're struggling to stabilize the yen, and as long as that friction between the yen and the dollar keeps rebalancing every time either country shifts interest rates, this kind of dip is going to keep showing up. The stock has already fully recovered from its end of July slump and is sitting near new highs today, which raises the real question. Is the growth story done? Or is this just the calm in the middle of a longer storm? The long-term case here isn't about riding a temporary bounce. It's about owning the one company standing between every chip maker on Earth and the ability to ship a working product. A company so essential that it's actually a candidate to eventually move its listing from the Nikkei over to the Nasdaq or NYSE, the way other major Asian tech names have started doing. Imagine you've been holding ARM for a while, tracking its earnings closely, feeling good about the business, and then, out of nowhere, the stock drops hard on a day when nothing about ARM's chips, licensing deals, or customers has changed at all. That's not a hypothetical. That's exactly what happens to ARM shareholders, again and again, for one specific reason. That reason is SoftBank, which owns roughly 90% of ARM. Anytime there's trouble in Japan, a yen shock, a Nikkei slide, it hits SoftBank first, and ARM gets pulled down right alongside it, purely through ownership, with zero fundamental issue at ARM itself. When you see ARM drop hard on a Japan-related headline, that's your signal that it's a discount, not a warning. Here's the practical part. These moves happen almost immediately, and the ripple effect across the tech sector takes roughly 48 hours to fully play out. Think of it like watching an infection spread across the market. So instead of trying to catch the exact bottom, you're better off buying in small tranches across that 48-hour window, averaging down as the price finds its actual floor. And this doesn't just apply to ARM. The whole tech and AI-adjacent sector tends to catch this same ripple, because that's where the volatility from these Korea and Japan events tends to concentrate. So we've covered 4 stocks, all tied to the same Korea-Japan volatility loop. But if you're only going to watch one of these closely, which one actually deserves the top spot? Let's count it down. Number 4, Advantest. An incredible moat, a real long-term story. But it's the most currency-sensitive of the 4, and its recent rally means you're not catching it at as clean a discount right now. Number 3, ARM. The SoftBank Connection makes it a reliable dip-buy signal, but it's an indirect play. You're betting on ownership structure reacting to Japan, not on ARM's own business. Number 2, Micron. Contractually sold-out capacity through 2027 makes this one of the safer buy-the-dip plays on this list, with real, locked-in revenue backing every share you buy. And number 1, Nvidia. It's the most obvious name on this list, but it's obvious for a reason. It's the first stock hedge funds sell for liquidity, which means it's also the stock that reacts fastest and hardest to this exact setup, every single time. If you only track one signal out of everything in this video, track Nvidia's reaction to the next Korea or Japan headline. The bigger lesson here goes beyond these 4 names. Some of the best buying opportunities in the market aren't created by bad news about a company. They're created by chaos happening somewhere else entirely. And the investors who understand where that chaos is going to ripple are the ones who get to buy quality at a discount, while everyone else is busy panicking over the wrong headline. If this breakdown helped you see the market a little differently, smash that like button. It really does help. And if you know someone who panic sells every time they see a scary headline, share this video with them, because this is exactly the kind of thing that could change how they react next time. And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. I'm Alex Carter, and I'll see you in the next one.